There's a number, a specific number, and once you hit it, you never have to work again. Not because you're retired, not because you're old, but because your investments are generating more cash than your lifestyle actually costs. Most Australians have absolutely no idea what that number is for them personally. Some think it's $10 million, and they give up before they even start. Others think it's completely out of reach on an average wage. But mate, today I'm going to show you exactly what that number looks like. And honestly, for most Aussies watching this, it's probably a lot closer than you think. Now, before I give you the number, I need to tell you something first. Something that makes Australia genuinely one of the best countries on the planet to pull this off. And it's something most people completely overlook when they're doing this calculation. It's not our property market, it's not superannuation, although that plays a role too. It's a little thing called the imputation system. And if you're not factoring this into your financial freedom plan, you are leaving serious money on the table. Here's how it works. When an Australian company makes a profit and pays you a dividend, they've already handed 30% of that profit straight to the ATO as company tax. Now, because the government doesn't want to tax that same dollar twice, once at the company level and again in your hands, they actually hand that tax back to you as a franking credit. What this means in practice is that a dividend yield that looks like 4% on paper is actually worth closer to 5.5, even 6% in your pocket once you account for those credits. The United States doesn't have this. The United Kingdom doesn't have this. Most of Europe doesn't have this. Australia and New Zealand are basically alone in running a full dividend imputation system, and that, right there, is a genuine structural edge that we have over almost everyone else in the world. And this isn't some new trick either. This system has been around since 1987, introduced under the Hawke government specifically to stop the double taxation of corporate profits. It's not a loophole. It's not something that's about to get quietly removed. It is baked into how the Australian tax system works. And it is one of the main reasons building a dividend portfolio here is so powerful compared to doing the exact same thing overseas. Now, before we get to the actual number, we need to settle something first. What does never working again actually mean for you? Because that answer is genuinely different for everyone. And the honest truth is, the number changes dramatically depending on your lifestyle. So let me give you 3 tiers, and I want you to think about which one you're actually aiming for. The Association of Superannuation Funds of Australia, the absolute gold standard for this kind of research, puts a comfortable lifestyle for a single Australian at around $54,000 a year. That's running a car, having private health cover, taking a domestic holiday once a year, and going out for dinner without having to check your bank balance first. For a couple, that number is around $77,000. Now, if you want the stripped back version, modest, functional, no complaints but no real indulgence either, you're looking at roughly $35,000 for a single person and around $51,000 for a couple. And if you want the full version, overseas trips, eating wherever you want, new car every few years, genuine financial luxury, you're realistically talking $100,000 a year or more. So pick your tier, mate, because the math I'm about to show you will hit very differently depending on which one you're actually chasing. Alright, here's the number. Or rather, here are the numbers. Because there isn't one single answer, there's a formula. And once you understand it, you can run it yourself in about 10 seconds. The average grossed up dividend yield on a well-constructed Australian share portfolio in 2026 sits at around 5.5%. That means for every dollar you have invested, you're generating roughly 5.5 cents in income every single year, after accounting for franking credits. So all you need to do is divide your target annual income by 5.5%, and you've got your number. If you want $50,000 a year to live on, you need around $910,000 invested. If $75,000 is your number, you're looking at approximately $1.36 million. Want $100,000 a year coming in without touching a job? That's roughly $1.82 million. And if you're going for the full $150,000 lifestyle, you need about $2.7 million working for you. Now, I know those numbers sound large, but stay with me, because the path to get there is genuinely more achievable than most people realize. And I'll show you exactly why in just a moment. But hold on, before you get too excited, there's a part of this equation that most financial freedom videos conveniently skip over: tax. Because yes, dividend income is taxable. And yes, you absolutely need to factor that into your planning, or your numbers will be off. Here's the good news though, and it's actually really good news. if you structure this correctly. The tax-free threshold in Australia sits at $18,200. And here's where franking credits do something genuinely powerful. If dividends are your only source of income, and you're holding a fully franked portfolio, you can receive somewhere around $30,000 in dividend income and pay basically zero net tax. The franking credits offset your tax liability almost completely at that income level. Now, once you get above that threshold, yes, you'll pay some tax. But even then, because franking credits effectively reduce your marginal rate, the after-tax income from an Australian dividend portfolio is significantly better than what overseas investors experience doing the exact same thing. The tax problem is real, but it is manageable. And for most people targeting a modest or comfortable lifestyle, it is far smaller than they feared. Here's the part I really want you to sit with, because this is where a lot of Australians mentally check out, and they really shouldn't. You do not need to save $900,000 in cash from scratch. What you need to do is invest consistently and let compounding build the rest. These are very different things, mate. If you put $1,500 a month into a diversified Australian share portfolio, generating 8% total returns, which is actually conservative by historical ASX standards, you will cross $900,000 in roughly 19 years. Bump that monthly contribution to $2,000, and you're there in about 17 years. Start this at 28, and you are genuinely, mathematically free before you turn 50. That is not a fantasy. That is arithmetic. And the beautiful part? As your income grows and you increase your contributions over time, that timeline compresses even further. Now here's the lever that most people in their 20s and 30s completely ignore, and honestly, it's probably the most powerful structural advantage available to any Australian building toward financial freedom. It's your superannuation. Contributions inside super are taxed at just 15% during accumulation, compared to your marginal rate of up to 47% outside super. And once you hit preservation age and shift into pension phase, the tax rate on income from your super portfolio drops to zero. Nothing. Zilch. That's why the smarter strategy for most Australians isn't choosing between inside and outside super. It's running both at the same time. A portfolio inside super, building quietly and tax efficiently for the long term, and a portfolio outside super that you can actually access before preservation age, for when you want to stop working early. I want to take a second here to save you from the most common, and honestly, most painful mistake I see new investors make when they're chasing dividend income. If you see a stock on the ASX paying 12 or 15% yield, your instinct might be that you found a shortcut. Mate, you haven't. A yield that high almost always means one of two things. Either the share price has already collapsed because the market can see the business is in serious trouble, or the dividend is about to be cut, and that yield is about to disappear. Either way, you lose. The companies that will pay you reliable, growing dividends for the next 20 or 30 years are not exciting. They are the big four banks, Wesfarmers, Woolworths, the major insurers, BHP in the right environment, Telstra since its restructure. Boring businesses, dominant market positions, decades of profit history behind them. That's what you want. Forever income doesn't come from chasing headlines. It comes from owning boring, durable businesses and holding them long enough for the compounding to actually work. Now, if picking individual stocks sounds overwhelming, and honestly, for most people starting out, it should sound at least a little daunting, there's a simpler approach that will outperform most stock pickers over a 20-year horizon. Aussie Dividend ETFs. VAS gives you the entire ASX 300 in a single trade with a yield of around 3.5 to 4% plus franking. BHY targets the higher yielding end of the market with around 5 to 6% before franking credits. You've also got iShares IOZ, BetaShares INCM for investors who want monthly income distributions, and a handful of others that give you instant exposure to 50 to 300 dividend-paying Australian companies with one single click. A simple 2 ETF portfolio, held consistently over 20 years, will quietly beat the overwhelming majority of people out there trying to pick winners. Trust me on that one. One more thing worth knowing, and most people don't figure this out until they're already trying to live off their portfolio. Australian ETFs typically pay quarterly, in January, April, July, and October. Individual ASX shares tend to pay twice a year, with most interim dividends landing in February or March, and finals coming through in August or September. That uneven cash flow can feel really uncomfortable when you're trying to replace a regular salary. The solution is something called a dividend calendar. Deliberately building your portfolio so income lands across the whole year, rather than arriving in lumps. Mix ETFs with direct shares across different reporting periods, and you can engineer something that feels remarkably close to a monthly paycheck. And that makes the psychological shift from employment income to investment income a whole lot smoother when the day finally comes. There's one more challenge I'd be doing you a disservice to ignore: inflation. If you need $54,000 to live comfortably today, in 10 years at 3% inflation, you'll need around $72,000. And in 20 years, you'll need close to $97,000 for the exact same lifestyle. This is why simply hitting your number and stopping isn't quite enough. You need a portfolio that grows its income over time, not just one that generates a fixed amount today. The reason dividend investing still solves this problem is that quality Australian companies don't just pay dividends, they grow them. The major banks have grown their dividends at roughly 4 to 5% per year on average across multiple decades. That's faster than inflation, mate. A well-constructed dividend portfolio doesn't just protect your purchasing power over time, it gradually expands it. Your income in year 20 should be considerably higher in real terms than it was in year 1. And that is exactly what you need if you're planning to fund 30 or 40 years of genuine freedom. And finally, the one tool that separates people who actually get there from people who almost get there: the Dividend Reinvestment Plan, or DRP. While you're still in the building phase, which, for most people watching this, is right now, instead of taking your dividend payments as cash, you reinvest them automatically back into more shares. Your shares generate dividends. Those dividends buy more shares. Those new shares generate more dividends. The snowball starts rolling slowly, and then it really starts rolling. By the time you're ready to flip the switch and actually live off the income, your portfolio will be generating dramatically more than it would have if you'd been spending along the way. The DRP is not glamorous. It doesn't make headlines, but it is one of the most powerful wealth-building tools available to any Australian investor, and it costs you absolutely nothing to use it. So here's where we land, mate. To never work again in Australia, you're realistically looking at somewhere between $900,000 and $1.8 million invested, depending entirely on the lifestyle you're building toward. You get there by investing consistently into quality Australian dividend stocks and ETFs, using franking credits to dramatically reduce your tax bill, running a dual-track strategy inside and outside super, avoiding high-yield traps, and giving the compounding snowball enough time and runway to do what it does. The path is long, but it is absolutely real, and it is available to any Australian who starts and stays consistent. If this video gave you something useful, do me a favor and hit the like button. It genuinely helps other Australians find this content. Subscribe Aussie Wealth if you're not already. Turn on notifications, because the next video is one you'll want to catch. I'll see you there, mate.